All right, so we've all heard the great debate between whole life and term life. We're going to talk about term life today and hopefully help you understand how these policies are built and the features. So, with the term life, essentially what you're doing is you are purchasing coverage for a specific time period, and then you will not have coverage. So, you pay one premium, they calculate one premium that you pay annually. It's the same. Okay, it does not increase. And the length of time that you're covered is specified. So commonly, it could be 5, 10, 15, 20, 30 years. So if you are 30 years old and you want to cover yourself all the way through retirement, you would get a 30-year term policy, right? It would cover you to age 60, more or less retirement age, and off you go. Once you hit 60, the policy expires and you no longer have life insurance coverage. So you're buying it for a specific length of time. Once the term expires, the coverage expires, death benefit goes away. As long as you keep paying the premiums, the life insurance company is obligated to pay the death benefit in that coverage period. If you don't have to choose to continue to pay the premiums though. Okay, you have the choice here. If you get a 30-year term policy and then 5 years in, you're like, yeah, I don't want this anymore. You just stop paying the premium. Okay, you are not obligated to keep the contract. The insurance company is obligated to honor the contract if and as long as you pay the premium. Okay, does that make sense? So the ball's in your court. You have the control here. So you're not locked in if you purchase a policy. You're not always locked into that. You have a choice. You can bounce. But you can also obligate the insurance company to stick around and pay the death benefit over that period. Sometimes at the end of this term period, there is the option to convert it to a whole life or a permanent type of insurance where they say, hey, it's about to expire. If you want to convert to permanent insurance, then here are the details. And you can convert it and then get coverage beyond that time period. Okay. Typically, you might do that because a lot of times they don't require a health exam, right? If you're going to go get insurance and qualify, they do the health exam, they have you answer all those questions. They might send a nurse to your home to actually assess your health and take your blood pressure and all that stuff. If you get towards the end of your term on term coverage and you're like, you know what, I actually want to keep this coverage around, so I'm going to convert, they would just tell you, okay, well, now it costs this much more to have this much of benefit, and you go through the details. But a lot of times you don't need to get an additional medical exam, okay, which can be beneficial if you've had medical problems crop up in the meantime. Because you are insuring only a specific period of time, the one guarantee we have in life, there are a number of guarantees, right? Taxes is one, but death, we are all going to die. It is guaranteed, period. So as you can imagine, purchasing an insurance contract that insures you for the entirety of your life, there is a 100% chance that the insurance company will pay out on that policy. They know they will pay out. They've just run their numbers to understand when it's more likely, statistically, that they'll have to pay out. But they will pay out. They know it, and you know it. It is guaranteed. With term, it's not that way, right? You have a set period where you're covered, and therefore it is not guaranteed that they're going to pay out a death benefit. There's statistical probabilities, and that's how they create your premium that you're paying, but they may never pay out on you. And so because of that, the risk to the insurance company is less, especially the younger that you are and the more healthy that you are, then the risk is really low. Okay. The odds of you, if you're in your 20s or 30s or whatever, the odds of you dying in the next 20 years are fairly low. They're pretty low actually. So the insurance company's like, yeah, we probably are not going to have to pay out on this person. Therefore, the premiums, generally speaking, are pretty inexpensive when you compare it to the amount of coverage you can get. Okay, so you can get a couple $1 million of life insurance coverage for less than $1,000 a year, for example. I've seen a lot of different quotes, and I have my own insurance. So I think I got my policy in my late 20s, and I got a $2 million policy. So I have $2 million of coverage. And I think my premium is around $800 a year. Okay, so all said, that's pretty inexpensive. If you were to look at whole life, that changes a lot, right? Because you are guaranteed to die. They're guaranteed to pay out the death benefit, and therefore the premium is a lot higher for every dollar of coverage that you get. So term life is fantastic for the following reasons. Number one, if you're insuring against loss of income. If you're young, again, we talked about this, the biggest risk to you is loss of income and income potential. And so if you're going to insure yourself during your working years and you get coverage to cover all of your working years or the majority of them, and you calculate how much that is, then you are covered during the most critical part of your financial life, right? Accumulation stage. Then, once you get towards retirement age, if you're, the whole time you've been working, you've been smart because you took this course, you have a plan, and you've been saving, you've been investing, you've been super smart, right? So you're building your assets the whole time. If you get to the end of your term period, right? Let's say you're in your mid 50s or late 50s or early 60s, and your insurance expires, well, you think about it, you've already earned the income you're going to earn, essentially. You've saved and invested what you're going to save. So now you have assets, right? If you were to die, your family has assets they could use, okay? So that's called self-insuring. You've basically self-insured by having enough assets to cover any needs that your family might have. And so you're basically getting to the point where you are self-insuring because you've been earning and saving and investing all during those working years. And by the point when your term insurance coverage is expiring, you essentially have the assets, right? You protected against your risk. It didn't happen. Great. And now you have assets and not a whole lot of future income potential because you're about to retire, right? Traditionally speaking. So for those reasons, term insurance, because it's the lowest, least expensive premium for the highest amount of benefit for that given period, I always go to term insurance first. We want to make sure we cover the risk of loss of income and future income. That is the biggest risk that we are covering right now. There are other risks we might want to cover and other reasons for permanent insurance. I'll talk about that in the future. But I want to make this crystal clear that this is the first place I go to get the proper amount of coverage that I need for the least amount of money. And then plan on either having other insurance that kicks in for the remainder of my life or self-insure. It's preference, it's up to you. So that's term life. It's pretty inexpensive because the risk is lower and you can get this pretty much anywhere. There's not a whole lot of features that add on to this. In some types of insurance, they have a lot of features and benefits, and riders is what they're called. Riders you can add on. Term life is pretty basic. You can get this in a lot of places. So I will link below this video to a number of places online that you can actually go and get quotes and get coverage. And so I'll link to that below. Obviously, you can speak to a life insurance agent, and they can also help with this as well. So that wraps up the term life conversation. We're going to move on next to permanent insurance.
The more clarity you gain, the more peace you create.